So Tom Lee just went full bear mode. I'm going to show you into my $816,000 trading account to show you how I'm going to orient myself going into the next 2 months, because Tom Lee just said in an interview that I'm about to play for you right now that the stock market could crash in the next 2 months. There's going to be a lot of opportunity out there. He said that you should definitely buy the dip. So we're going to break down the interview. I'm going to show you into my trading account. We're going to figure out how we need to handle this situation, because this could be a really big dip right here. So we want to make sure that we're ready for it. So here's the interview.
Your outlook and views are always nuanced to some extent, Tom. So last time you were on, after being pretty bullish on small caps through the end of the year, I wouldn't say you didn't change that long-term view, but you did express some near-term caution. And these people want to know, the people that follow you, the people that watch Squawk Box, they want to know exactly what to do every minute of every day. So it looked to them like you had waffled on your long-term view. And you're going to say the same thing today. I think near-term, you acknowledge that there could be some bumpiness, choppiness, but by the end of the year, you think 6,000 on the S&P.
That's right. I think we're still in the midst of a very tricky period because we've got the election in less than 35 days, and now we've got two things that investors don't know how to discount. One is, mounting tensions in the Middle East, and then a port strike that is potentially going to cripple the economy.
So the port strike could be really bad for the U.S. economy, because ports is where we import stuff from other countries, and ports are also where we export our goods too. So companies that are American-based that produce stuff in America and are trying to ship stuff out through the ports, they won't be able to do it, so those companies aren't going to be able to make as much money. And then all the stuff that we're importing into those ports, that stuff is going to be stuck at sea. Nobody's going to be able to get the products that they're looking for, so there might be shortages. This might cause inflation. This could be bad for the economy. It's going to put things on hold. So we really need to get this port strike figured out sooner rather than later.
As investors worry about this, if we get a dip, and a big dip, I think you still want to buy that dip because the setup into year end has a lot of tailwinds.
The worst case scenario for the port situation is something that we've seen. And we shut down an economy already, and that was probably a time to buy. I can't imagine it could be as bad as the pandemic, but we have shut down an economy before.
Yeah, that's right. So I think it creates headline risk because, the longer this strike lasts, there'll be companies that miss, and so S&P earnings might get downgraded or some stocks might miss results. But that's all just temporary. I mean, those are just short-term headwinds because it doesn't change the long-term outlook.
So what Tom Lee is saying right here is less than 2 months away we have an election, so there's a lot of uncertainty built around that. But now adding this whole port situation into that, when the stock market appears to be a little bit overvalued right now, it sets up for potential for the stock market to take a big dip.
In fact, if we look at the last 6 sort of global wars or tensions, you almost always buy the invasion. The exception was 2022 with the Russia-Ukraine war because we were also in the midst of a Fed tightening cycle. So that was not a buy the invasion event. But the other times you did want to buy.
So Tom Lee's talking about this period right here from 2022 to 2023. This is where the S&P 500 went down roughly 20%. This is most likely caused by the Federal Reserve raising interest rates. And as you raise interest rates, stock market valuations typically come down. So that's why buying the invasion did not play out for this situation right here.
This is different because we are hovering near highs and we're in an extended market.
And things aren't cheap in terms of multiples.
That's right.
So if you look at this chart right here, this is a chart of the S&P 500. The red line is the share price of the S&P 500, but this green line right here, it shows you the PE ratio of the S&P 500 from 2004 to current. So if you look up right here, the forward P ratio for the S&P 500 is 21.6. Look at this whole time period right here. How many times was the PE ratio above 21.6? Pretty much nowhere except right here. It looks like in this whole time period right here, the average PE ratio was somewhere around like 16 or 17, and right now we're at 21.6. So it appears that the stock market is a little bit overvalued right now, but here's the deal. As interest rates go down, stock market PE ratios typically go up because interest rates are like gravity. The lower the interest rates, the higher that stocks could go.
At the same time, we also know there is a lot of cash on the sidelines.
Right.
Because margin debt hasn't risen for 4 months. I mean, that's pretty unusual with a rising stock market. And now money market cash has actually been rising at a time when the Fed is cutting. So I do think there's firepower.
So typically with money market accounts, that's kind of like a savings account. So as savings rates go down, as interest rates go down, you're going to make less money on your money when you do money market accounts. So it's kind of unusual to Tom Lee that why are more people putting money into money market accounts when they're getting a lower interest rate as rates fall. So what's going to happen, he expects, is that people are going to take that money from money markets because as rates go from 4 to 3 to 2%, they're going to say, screw that, I don't want to put my money there, I'm going to put my money in the stock market. So that's what's going to help push the stock market higher.
The other issue, just the longshoreman strike, if that goes on for an extended period of time, is that something, we were talking before how much that cuts off the GDP. If it's there for a week, maybe cuts 0.3 of the GDP.
Yeah.
For every week they're out. Is that something that the Fed comes in with much more aggressive cuts and that fixes things, or are there inflationary factors that also come into play and that ties their hands?
I mean, the Fed has to kind of put that in their calculus because the labor market has also softened. So if this is a shock in a way that causes the labor market to weaken, the Fed's going to be a lot more dovish. But we get the payrolls report Friday, and I'd say maybe it sort of early hints seem like it's actually going to be a better than expected report.
So what Tom Lee is saying right here is the port strike could actually be really bad for the economy, but he's talking about a jobs report that comes out in a couple days, and he's expecting that jobs report to be strong. But here's the deal, the stuff that's happening with this port strike, it's not going to be reflected yet in that jobs data. That data is going to be a little bit laggy. The actual impact from the port strike, it's going to take a couple months for that to start reflecting into the jobs data to actually hurt the economy, and that's the issue with the Federal Reserve and how the economy works and getting data. The data is usually always laggy, so it's really hard to try to predict how much is this port strike really going to hurt the economy, because let's just say they resolve this stuff in a week from right now, we're not really going to know the impact of that for maybe a month or two from that point.
Not only did China launch a bazooka, but it's really working, right? Because the stock market has really broken out. I think China is now the best performing stock market this year.
But was the move made? I mean, I think, we had Kyle Bass on yesterday, and I think he would argue long term, no matter how you want to think about China, it's a bad bet. He was suggesting maybe in the short term, it's a good bet. And I don't think he was necessarily opining on whether the bet is over. But the move, obviously, the big move has happened. The question is, do you see that doubling? Is that in the cards at this point of the game?
Yeah, I mean, something to keep in people's back of their mind. Over the last 10 years, China has underperformed the U.S. by 7,700 basis points. So if China doubles, it's still underperformed by 1,000 basis points. So, I mean, there's a lot of room for a rally, even if it looks corrective.
So what Tom Lee is saying is the Chinese stock market has underperformed the S&P 500 by 77% in the last 10 years. So even if the Chinese stock market goes way up, it's still probably going to be lagging behind the S&P 500. All right, so now let's hop over to my $816,000 trading account. We're going to talk about some of the trades that I have open in this account, and we're going to talk about what I think is going to happen in the stock market for the next 6 months and then going forward into the future. So my 2-year return on this portfolio, I made $556,000. So to go from almost nothing to over $800,000 in roughly 5 years, that's a pretty good return on your investment. Now, I didn't do this by just buying shares. I do a lot with stock options. I'm going to show you into my portfolio in a little bit. Rule number 1 of investing is to not get wiped out. That is rule number 1. Don't get wiped out. Don't do something that can reset your trading account at zero. You have to make sure you understand this stuff. You got to make sure you do it right, because so many people lose money trading stocks, and especially stock options. So I really want people to learn how to do this the right way. All right, so let's go into my account. So just to show you my return in 2023, for example, I made 75% return on my investment in 2023. This is not me sending any money to this Charles Schwab account. You can see right here, my net contribution is actually negative $24,000. So I started with $290K, it went to $506,000 at the end of 2023, and then right now, I went from $506 to now this account is over $816,000. So I'm absolutely crushing it right now. The trades that I'm doing are printing money. So if you want to learn how to do that, check the link below for my course. I'm going to teach you exactly how I do this stuff. So hopping into my trading account right now, the value is $750K. It's less than what the total value of Schwab is. Because I have multiple accounts in Schwab, I have a couple Roth accounts for me and my wife. So this account right here is $750,000. You can see my total gain loss is $263,000, and the cost basis is $489,000. So here's the deal with these two things right here. This is total cost basis and total gain loss for the positions that are currently open right now. This does not factor in positions that I made in the past. So let's say in the past that I bought Amazon stock, made a bunch of money on it, and then sold those shares. When I sell those shares of Amazon, that goes to this account in cash. But then when I go buy shares of, say, Triple Q, for example, it shows you that my cost basis right here is $313,000. So let's just pretend that I took $1,000 and I made $313,000 on one trade. That would be a pretty dang good trade. That would be crazy. But if I started my account with $1,000, made it go to $313,000, I take that $313,000 and I go buy shares of Triple Q, my cost basis will show $313,000 because truly that's what the cost basis is, but that is not how much money you actually sent to this trading account. So keep that in mind, that gain, loss, and cost basis when you look at your account, that is only based on what the current positions are. So you can see the base of my portfolio, I have Triple Q and I have VOO, and this is just my trading account. I have multiple other accounts. I have a Vanguard account, I have an E-Trade account, I have a Fidelity account. Those accounts, I have a bunch of other shares like Amazon, I have Apple, I have JP Morgan Chase, I have Bank of America. There's a couple other things that I have in those accounts. So you can see there's like $440,000 worth of Triple Q, $240K of VOO. Tesla, I have 500 shares, $124,000 is the value. Don't forget, on October 10th of this year, Tesla has their Robotaxi day. This is going to be a really big day for Tesla stock. The Tesla stock valuation right now, in my opinion, is a little bit overvalued. But if Tesla actually comes out with the Robotaxi and they come out with the Optimus robot, that could be so huge going into the future. Like buying Tesla stock right now for $249 per share, this might be pennies on the dollar when we factor in Robotaxi and the Optimus robot. Maybe 5 or 10 years from right now, Tesla stock could be in the thousands of dollars per share. So I wouldn't be surprised if this $124,000 right here is $1 million going into the future, maybe like 5 or 10 years from right now, because if they do what they're really trying to do, that could be astronomical for the stock price. So you can see right here, I sold some puts on Tesla, I sold some puts on Triple Q, sold some puts on Apple, sold some Triple Q puts again, got some IWM puts, pretty much flat on the IWMs. I have some TLT calls that I still have open. I'm down a little bit on those. I have NVIDIA calls, I'm down a little bit on those. And I have SQQQ calls, I'm down on those too. And I've talked in other videos, and you guys have to understand that I really want to be down on these SQQQ calls because SQQQ is short Triple Q. So when Triple Q goes down, this goes up in value right here. And then as a whole, I'm up $263,000 on my open positions right now. And you can see this stuff that I have right here. The percent of my account, it's a very low percent of my account. You can see the bulk of this account is 50% in Triple Q, almost 30% in VOO, and 15% in Tesla, and then the rest is just in other stuff. So the stock market going into the election could be very bumpy. There's definitely margin to buy the dip. If the stock market falls quite a bit, I'll be buying calls, I'll be selling puts, I will be making more trades. And if you want to get my live trade alerts, check out my Discord, but the only way that you could get my live alerts is you have to go through my course because I want people in that premium Discord that know what they're talking about, that have been through my course, and we're all on the same playing field. The benefit of being in there is because everybody else in that premium Discord, it's kind of like a mastermind group. Everyone else that's in that Discord, they have been through the course too. So it's like a big mastermind group of people talking about stocks and stock options, and we're always trying to spot market opportunities to make trades on. So if you're interested in that, check out the link below for my course. I also have a free stock market blueprint to get you started. That's going to help out the average Joe investor. And if you made it this far, like, subscribe, and I'll see you guys later.